Today, we're delighted to have William Chang with us on the show. William is head of Asian Pacific Client Portfolio Management of Franklin Equity Group, part of the Franklin Templeton Group, which manages nearly $2 trillion in client assets. Prior to joining Franklin Templeton, William was a vice president at Goldman Sachs Asset Management. William holds a bachelor's in operations research and industrial engineering from Cornell University and is a CFA charter holder. William, thank you so much for joining us.
It's great to be here.
Bright and early in Singapore.
Yeah, that's right.
And I don't need to ask you what the weather is like because it's always sort of hazy, hot, and humid. So what did they actually talk about to start with? First, it seems everybody wants to get involved in AI, and you get rewarded for getting involved in AI. So the question is, with all this money that's going in, OpenAI, in particular, but other name is there value here? I mean, how is OpenAI going to pay for all of this stuff?
Yeah, definitely. That's a great question. And, certainly when it comes to the AI build out, there's been a lot of news in terms of the build outs that are scheduled for new data centers. Now, with specifically regards to your question, we think this is a incrementally positive data point for both GPU manufacturers such as Nvidia and AMD, as well as OpenAI. What was signed was essentially a partnership where OpenAI would be purchasing about $100 billion worth of AMD products over time, and OpenAI would also receive warrants in AMD's company. But we see this as a little bit of a necessary partnership. And, you've seen similar announcements through other GPU makers. So Nvidia had mentioned a comparable deal with Intel. And it's the sort of thing that we see as basically hardware makers and the people that develop models working together to strengthen the ecosystem. Now, certainly, when we think about infrastructure and GPU makers, what is really responsible for kind of driving use of GPUs? Well, it's the models that are being built and trained and ultimately used on the hardware. So, we think this sort of, for the lack of a better word, relationship between both the hardware and kind of model side of things is necessary to continue growing the ecosystem. Now, we don't really see this as a bubble. And the reason for that is when we think about basically the size and the complexity of data centers yet to come, it's actually significantly much larger than I think most people would expect. Right now, some of the data centers that we're seeing are in the size of 100 to 200,000 GPU cluster sizes. There are expanded plans to grow that to 1 million to 2 million GPUs. So just the scale of future data centers are expected to be significantly larger. Now, in terms of how does a company like OpenAI, or more generally, how do some of these companies pay for these sort of purchases? Well, certainly, I think, what is being unlocked here is a great amount of productivity, whether it's using ChatGPT or other large language models. We think that these models, and, there's been surveys that have indicated productivity gains of anywhere between 20 to 40%, depending on the exact function that you're looking at. So as an example, if we were to say, look, who does this impact? Well, we're really looking at knowledge workers who take advantage of these models. And these language models are going to be used by knowledge workers to enhance their productivity. And when you think about how large of a market that is, there's roughly we would estimate roughly 1 billion knowledge workers across the world.
Wow, that's an interesting way. I've never quite thought about it like that. A billion knowledge workers. Like what's a knowledge worker that we wouldn't normally think is a knowledge worker? So billion's a lot of people.
Yeah, definitely. So I would think, maybe the broadest way to think about it is anybody who interacts, creates, or analyzes data to be defined as a knowledge worker. And that could be you or I. So if you think about, for example, we're sitting here on a video platform having a conversation, but we are inherently creating a transcript. We are creating some sort of media that is going to be used and consumed to educate people. And people are going to be deriving use out of this data that we're kind of transcribing into video. But alternately, knowledge workers could take the form of, say, medical researchers. It could take the form of anybody who's looking to develop new materials, for example, anybody who works in the financial services industry who might be using data to make a credit underwriting decision. So certainly the population is quite vast in terms of who can potentially benefit from this data, which is why we feel that generative AI is such a transformative potential to globally.
You just used this term generative AI. Can you just explain that a little bit?
Yeah, sure, absolutely. So when we think about artificial intelligence, the earlier stages, it was really kind of built on statistical analysis. And basically, it would look at data, explore relationships between words or phrases, and basically it would come to a conclusion. So, for example, if I were to say, look, I'm thinking of an animal, it's a domestic one, it has four legs, and is capable of biting people. AI might look at that and say, well, statistically, I think what you're describing is a dog. What generative AI is capable of doing is you feed it that same sort of information, and now all of a sudden, it knows that you are likely describing a dog, and it can offer you options. It can say, well, look, tell me more about this animal. I can actually generate a photo of such a dog. I know because I now understand what a dog is. By understanding the data underneath it and the linkages and what the common characteristics are of the underlying data that you're feeding it, it can actually generate new, or I guess synthesized information beyond the scope of just kind of comparing relationships between data.
Right, right. I want to go back because I'm still really like amazed that the your figure about a billion knowledge workers. So a billion knowledge workers, right? Let's say, and I just want to take numbers like it's just like a consulting interview, and I hope I don't get a zero wrong because that's the big numbers. I'm always afraid of that. The billion knowledge workers, and you would pay. Let's say they get paid. You said $50,000 a year on average, which seems reasonable. If you would you pay $10,000 a person or to make them 20 to 40% more more effective, more productive? That seems reasonable, right? So at 10,000 at $10,000 a person, at a billion, is that $10 trillion? Do I have that right?
That would be a trillion.
It would be a trillion. Okay, a trillion. Okay. So yes, this is a big numbers. That's why I kind of worried about it. But so there's $1 trillion in sort of addressable revenue in that way. I guess it's we probably both use Bloomberg's or have used Bloomberg's over time. And they're $3,000 a month. That's $36,000 a year. Would you pay a third of that, $10,000 a year to go ahead and make them 20 or 40% more effective, more productive? That's actually pretty reasonable. So thank you, because that's really like, it helps put your arms around a number, because you just see these numbers and you're like, how are they going to actually end up paying for it? How do you convince people, businesses to come out with come up with these dollars?
If it's helpful at all, I mean, I could share a couple examples across industry.
Please.
Because a lot of times I think people think of generative AI as a tool that's maybe more found in the domains of, say, information technology or the financial sector, kind of what I'll call the obvious kind of low-hanging fruit beneficiaries, both sectors, whether it's the financial services industry or information technology, obviously very intensive in terms of the number of knowledge workers. But certainly we've seen a lot of adoption across other sectors as well. So when we think about healthcare, for example, some companies now use AI to basically look at imaging. The National Institute of Health in Britain has now announced that they are going to be using generative AI as a tool to help them with diagnostics. There are companies like Teladoc who has indicated that they've been able to see 25% more patients as a result of leveraging generative AI. Companies like Walmart have indicated that as a result of using generative AI, they would not have been able to accomplish the same amount of work without 100 times more workers. So you see a lot of the sort of multiplicative leverage that AI is able to provide. Vodafone, so in the telecom industry, has indicated that they save on average about, it's estimated, 3 hours per employee per week, and they have declared employee count of about 68,000. So you're looking at about a 200,000 hours of savings a week as a result of using AI. And then in the financial space, JP Morgan has indicated use of AI has saved them, has generated about savings of, they estimate, anywhere between $1.5 billion to $2 billion in savings. And you see that across a lot of different sectors, right? So whether that's retail on the Walmart side, JP Morgan on the financial side, Teladoc on the healthcare side, and then even say Google, for example. Let's take one in information technology. They've indicated that roughly about 25% of the code that they write internally is generated through AI, and Meta has made a similar claim as well. So we are seeing lots and lots of leverage, which gets us very excited about this sector.
A question, and maybe you can help me with it. So let's just take J.P. Morgan for example. I'm sure they have all sorts of guardrails around their AI, and I'm sure you actually can't log into Chat GPT from inside their firewall and ask it a question. So what do they pay a provider or multiple providers for a specific tailored AI, like Chat GPT for JP Morgan or Perplexity for JP Morgan, and then they pay a fee per user or fee per use or something like that? Like, is it basically these folks who are, or OpenAI, who are Chat GPT, who essentially will create one for you, but you have to pay us a subscription fee? Is that how it has been working?
Yeah, I mean, I can't comment specifically on JP Morgan and their particular subscriptions or use case. But what I would say more generally, kind of looking at the financial sector, is typically this is the sort of thing where you will leverage a little bit of the technology of outside vendors. So a number of the ones that you had mentioned, whether it's OpenAI, Microsoft Copilot tends to be another one that I see pop up quite a bit, Perplexity as well. But you're right in highlighting that there are concerns around data. So a lot of it is proprietary, and a lot of times you don't want that data leaking out. There's concerns about privacy. There's concerns about regulatory risk. So typically, financial institutions will partner with a large language model provider, and they will either work with their tech teams to create a more kind of custom tailored version of those models that lives more locally and can basically work and train on bank or financial institution specific data. Or what will end up happening is they have a license to some of these outside providers where there's still a little bit of a division. So you can leverage these models to kind of accomplish more generalized tasks, but it may not have access to kind of more sensitive data within the institution.
I guess that makes it's great in a way where you have the same, if you're one of the AI folks, you have the same underlying code and tool, but you can tailor it for everybody, for many hundreds, if not hundreds and thousands, or perhaps hundreds of thousands of ways for people who want their own, sort of sequestered, I guess, data, and charge them each, over and over again. So I guess it's in a way, it's how do they charge this and build that out properly? Now, in terms of if you were an investor, whether it's an Asian investor or a U.S. investor, and you feel like you do that, AI isn't a bubble and there's a huge addressable market, how do you get exposure to that as a say a sophisticated retail investor?
Yeah, that's a great question. And I would say there's a couple different ways to approach getting exposure. Certainly, where we've seen a lot of interest, and I think probably the most visible kind of exposure is certainly on the hardware side. So names that I think people are pretty familiar with already. Nvidia has been kind of at the forefront of most investors' minds. And now, as you mentioned, this AMD deal, I think while people have seen AMD as potentially a secondary player in the market, I think this latest deal that was announced with OpenAI, I think tends to bring the name much more to the forefront. And then other kind of chip and hardware names as well, right? So Broadcom. I'm not endorsing any of these companies specifically, but just when people talk about the hardware side of things, these are some of the names that people typically think of. So Broadcom, for example, TSM on the manufacturing side, KLA, Tencor, ASML, certainly when it comes to semi-cap capital equipment. These are all names responsible for making essentially the guts of what these models are trained on, and where I think a lot of attention has been focused. I think where we see the puck moving a little bit and the underappreciated potential. We see a huge opportunity on the software side of things. And we think that's a little bit underappreciated because there's a little bit of a misunderstanding as to the impact of generative AI on software. And what I mean by that is, I think when it comes to generative AI, there's a perception that generative AI can write code very quickly. So in some ways, perhaps disintermediate what software companies are creating, right? But what we've found is that generative AI has actually worked quite well as a partner to these software companies. And what I mean by that is that now all of a sudden, by using generative AI, you can write software quicker, you can create better functionality, and software companies can charge more for these premium features. And one example of this, I would say, is Microsoft Copilot, right? Up until, I would say, a couple of years ago, nobody was really using Copilot. In fact, the introduction of Copilot was something that was kind of novel at first. And over time, as the model got better, as their partnership with OpenAI strengthened, and these models became more effective, then it actually became a pretty credible tool for knowledge workers to use. And if you think about the kind of basic math behind it, let's just say they charge on average $20 a month per user. It's $240 a year for a license. Multiplied by 1,000. All of a sudden, that's $250,000 in additional revenues to Microsoft, and that's only one company, and that's only assuming 1,000 people using it. Now, that was $250,000 in revenue that Microsoft didn't previously have, but now it's kind of, I don't want to say come out of thin air, but in a lot of ways, generative AI has been additive to them. It hasn't detracted from the software. It's actually enhanced their ability to sell something new. And then the other aspect that we think, that's quite positive for software companies using generative AI, as they create new tools and they're able to sell them, the other way that they're actually able to benefit is to actually streamline their operations. So I mentioned before, Alphabet, and so Google essentially, and Meta being able to generate, a material amount of their code through generative AI. Well, if that's the case, you no longer need as large of engineering and kind of programming teams going forward. So I think software companies going forward are going to get a little bit of a dual benefit. So that's both from being able to introducing more complex software with better features that they can charge a premium for. But then on top of that, they can also cost contain by managing their expenses internally by leveraging generative AI for some of the tasks that they normally do.
Right, right. No, it'll be interesting to see. You mentioned Microsoft Copilot, and it's brilliant, right? Who's not using Microsoft? Essentially. So we've got this new thing here. You're going to pay $20 for it per person, per month. If that's the right number, which we're kind of using it as an example, and you're going to be happy about it. And I don't think anybody's going. Well, we're no longer to use Microsoft's suite of tools because because of Copilot. It is just generally additional revenue. And in 5 or 10 years, what is the landscape going to look like? I mean, I expect that perhaps it's going to be bumpy along the way, where you'll have some of these AI companies like at OpenAI, and you're reporting, and the numbers don't look great for a couple of quarters. But as you've actually walked us through, there's a big part of the there's a large addressable market that we haven't really gotten into yet. It's just the road to there will be pretty interesting. And it made me sort of smile, because I remember back in this might be a little bit before your time, when Bill Gates put in, I think it was $150 million literally to save Apple, because he had the money and Apple was in desperate need, and sort of the Nvidia Intel just reminds me of that. And once again, it's sort of software, you need a hardware partner. It's a brilliant move.
Yeah. Well, I mean, to harp on something that you raised, I think it was just a really good point. It is going to be a bumpy ride, right? I think, back to your earlier comment with regards to, is this a bubble? I think, there will be ebbs and flows of, investor expectations. And, we would not say it's a smooth sailing ahead. And part of this is a little bit predicated on the fact that AI is so powerful, that expectations for the technology, can run really far, right? I think the way that you and I are talking about AI, certainly is in a much more measured way. But I think when you talk to some people about AI, they think it's going to take over the world tomorrow. And we don't think that's necessarily the case. Some of the common kind of headwinds that we see are a kind of threefold, I would say, and most people don't necessarily appreciate this. MIT had recently put out a paper, in fact, basically pouring a little bit of cold water on the impact of AI. But I think it's completely understandable where they're coming from, because I mean, as I kind of think about why the kind of enthusiasm for AI has come as far as it has, it still faces a couple headwinds. One, I think when you think about companies' adoption of AI, it's not necessarily the case that people are just adopting AI wholesale, right? Particularly in regulated industries where the adoption rate may be slowed because of regulatory considerations. So if I work in a financial company and I get something wrong, I may earn myself a fine or a sanction. If I am a medical company or a healthcare company, and all of a sudden AI is making a recommendation that's not true to life or beneficial for my client, that is also potentially something that could be damaging for the company. So certainly, I think when it comes to the company adoption, it may not come as quickly as people have now been accustomed to kind of thinking it might, but you are seeing the investments being made in it. And when you look at the sort of skills that AI is adopting, the kind of human-like features, we find that in a lot of cases, AI is getting exceptionally better compared to where they were a couple of years ago. But if you think about the models that we're using now, they are essentially the worst version of the models. By tomorrow, you will already have a better model, and that just comes with additional training.
So moving along from AI, I mean, we could talk about this all day, but there are some a lot of other things I'd like to get your insights on. Um, the sort of the Mag 7 or Mag 6 or however you want to call it, these really large cap growth companies have led an unbelievable rally in the broad index and the S&P 500. When it was $4,800 on April 8th or whatever it was, I don't think anybody saw where it is today, and that's been led by this large cap growth. Now, over time, I can remember sort of like 1991, 1994, 2000, some times like that when you had large cap growth lead, and all of a sudden they really underperform on a relative basis for not any number of reasons. And then small cap value stock that have relatively outperformed for some period of time before they switch. Do you see any signs that that we could be moving on from large cap growth, where it might, because of the rally that it's had, that they may start to underperform sort of smaller names like the other 493 stocks in the S&P 500, or or for even smaller ones, the Russell 2000. I mean, two different universes, but the idea is how much longer can they lead the market?
Yeah, definitely. So I think it's difficult to put a precise timeline on that. But I mean, taking a step back and addressing your question, I think on the broadening of the market, that is something that we think is likely to happen. Um, you know, but certainly when you think about valuations for some of these mega cap names, they are higher than some of their small cap peers. And in some cases, we feel like they're justified. Certainly when you look at the forward growth prospects for a lot of these names, I'm not necessarily just thinking about price to earnings, but I'm also thinking about things price to earnings, relative to its growth rate a couple years out, right? So if I just look at headline price to earnings multiples, there are other companies that are way more expensive than, say, the Mag 7 if I fail to consider the growth rates that some of these Mag 7 companies present. Now, having said that, there are also, as you rightly pointed out, 493 other names in the S&P 500. Some are much smaller, which have less demanding valuations. And we think that in the future, coming months and quarters, some of these names could stand to benefit from that, right? And part of the reason is driven by kind of headline valuations. But the other aspect that, kind of going back to what we had discussed on generative AI, is that these are the companies that are also implementing these technologies and models in their businesses. So you are likely to see some of these companies be the beneficiary of whether it's cost cutting or growing new lines of business. And we think those sort of smaller companies could be more interesting. So you get not only the kind of interest coming from a relative valuation perspective, but you would get a little bit more growth or a kind of margin management. So from a valuation perspective, that would be kind of the catalyst that people may pay attention to these names. But then when you think about the earnings growth that they could potentially generate, that's also another source of potential attraction.
Right, sort of in a way, a rising tide lifts the boats of the other 493 because they'll be more efficient, and there'll be sort of dislocations in terms of do you need any employees, and then as we've seen time after time, with a great advance in technology, just the workforce changes, and overall it has always seemed to be a good thing, although that change can sometimes be a bit bumpy. I want to ask you about what. And given that you're in Singapore, and the one of the drawbacks of sitting here in the U.S. is you really hear a lot of news from the U.S. point of view, and you don't hear what international investors are thinking. So in APAC, to the clients that you're talking to generally, what do they think? What do they think of U.S. assets? And I mean, equities and bonds, and then also the U.S. dollar. Are they? I mean, certainly the phenomenon that is Trump has not been seen before and may not be seen again. What are they thinking about U.S. assets?
Well, after Trump came out and spoke the other day, I think I have to be careful in what I say, right? I can't be too critical. But all jokes aside, I think there is some concern, right? The concept of U.S. exceptionalism has been shaken a little bit. I would say dented, not broken. But I think when it comes to our kind of geopolitical ties across the world and our allies, that is something that is being evaluated, taken a second look at. Certainly, when it comes to the U.S. equity markets, however, I think there's still a recognition that U.S. assets are kind of the gold standard. You have very deep markets. You have a huge bed of innovation that's happening in the U.S. And it's one of the best places in the world to go for capital if you're looking for investment opportunities. Now, having said that, given kind of the decline in the U.S. dollar, certainly, there's a recognition that there's a lot of things that China does well. Certainly within the generative AI space as well. We had DeepSeek news break earlier this year, late January, which was seen as a potential rival. But overall, U.S. equities is still a good market. I don't think anybody's leaving the U.S. markets in mass, but people are thinking about it a little bit more cautiously, just given the sort of geopolitical factors that have come more into play recently.
So the folks who are who still like U.S. equities because they're the capacity for growth is quite remarkable, certainly on an absolute as well as relative basis. Are they thinking about hedging dollar exposure to that? Dollar's down probably, the dollar index is down 10-12% a year so far this year. And it's probably right in the center of where it is over the past, 20 or 30 years. So, perhaps it's fairly valued, but are they thinking we need to hedge our dollar exposure where perhaps previously it was sort of let it run?
I haven't seen too much evidence of that. Where I have seen a little bit more kind of what I'll call a foreign exchange directed activity. It's a little bit actually of a pickup in interest in U.S. equities. So some of the investors that I've spoken to, they're actually piling a little bit more into U.S. equities with the expectation that their local currency is actually appreciated. And whereas historically they would not have had the opportunity to own U.S. assets, they feel like they're getting U.S. assets on the cheap. And in some cases, one country that I'm thinking of has opened actually local currency share classes. Where they're essentially trying to collect more local currency and translate that over to US dollar assets, knowing that this is going to be a good opportunity for this asset manager to basically pick up dollar denominated assets on the cheap and hold into the future where the dollar may stage a rebound.
Wow, that is fascinating. I want to move to sort of the 800-pound gorilla in the room, so to speak, or maybe that's actually not quite accurate. But the Chinese benchmark has had a really good run this year. They had about a year ago, they had that announcement just before they went away for their week long holiday, which they're in the middle of right now. And the I think the CSI 300 whatever was just exploded and then consolidated for the better part of a year. But then now it's had a really really good run. Now in terms of and you hear about some Western investors. I suspect the shorter term tactical folks are looking, been playing more in Chinese shares or in different parts of China. From what's the Asian point of view? And again, in terms of where you're sitting, your clients are they, had they moved funds out of China in recent years when sort of the big growth industries were sort of suppressed a little bit, I would say 3 or 4 years ago. Did they move money out, and are they thinking about moving money back? Do they feel that there is a real opportunity there? We don't see this in the U.S. very much.
Yeah, I think it's a little bit of everything that you mentioned, right? Certainly, when markets corrected pretty significantly, you saw a lot of outflows. But it's a little bit similar to gold, I would say. Certainly with the large run up in Chinese indices over the past couple months, there's been a renewed interest. In some ways, assets have gotten fairly cheap. And so the thinking is that, well, look, at valuations so cheap, could there be something that we're missing here? And I think we've seen positive news out of China, whether it's in the form of DeepSeek and kind of AI, and a competing technology that could give OpenAI potential run for its money. I mean, we don't think they're quite comparable, but certainly it has presented a number of proxies that are very similar in the AI space. Huawei has come up with a technology, while not cutting edge, can daisy chain 15,000 different GPUs together to present a pretty powerful processor. And so I think it's news, positive news coming out of China like this that makes people reassess. Have we been a little bit too hasty, completely moving out? Are there opportunities that are not being appreciated by the market right now? As China continues to remain one of the world's largest manufacturing companies, are there economies of scale where now the world has kind of gotten addicted to Chinese manufacturing? And, a couple months or years ago, when people were looking for alternative manufacturing, have they really been able to grow the scale in other countries? Or is the right move to kind of look at China again and just to say, no, they have a really competitive edge here. And we might be missing some opportunities that we would have exited hastily a couple of years ago.
So I guess it would be fair to say that people are looking at China with, sort of, from I guess the rest of East Asia, with some interest, saying maybe we have to, or we've gotten a little more involved, that we perhaps may need to get more involved. As it seems that the government is certainly happy with monetary stimulus, although on the fiscal side they are incredibly prudent, which I find to be really ironic.
I think it's that, and I think it's really people look at it with with a healthy dose of skepticism. I think some of the measures that have come down from the government with regards to you know kind of whiplash regulation is something that I get the sense investors have some apprehension about. So if all of a sudden the government passed some sort of regulation that makes it really difficult for one particular industry, like Chinese online education, for example, or certain financial firms to do business. Yeah, it's the sort of thing that no one can really anticipate to a great degree. And as an investor, you have to have a ample amount of kind of risk awareness before you decide to enter into a market like that. So I think now investors are a little bit more risk aware, and they're kind of looking at things through, yes, it's very attractive based on what we've seen in terms of performance over the past couple months. But how comfortable are we? And what's the right sizing if we do decide to enter in? And are some of these regulations, could they change again, where we might get caught in a position where we are forced to liquidate a position? So I think these are some of the concerns that they might have.
Right, right. In terms of the right size allocation, that makes a lot of sense. So I guess to close, we're in the fourth quarter of what has been an incredibly tumultuous year. What are the things that sort of the two or three things that you're looking for, in the fourth quarter here for the overall direction of, say U.S. markets or other major markets for the near future? Like what are you looking at? What do you wake up, you turn on your Bloomberg. What draws your eye first?
Yeah, definitely. I think a little bit more clarity out of the U.S. certainly would not be would not be a bad thing. So certainly one of the things that we're kind of focused on is more clarity around U.S. regulation. I mean, by this, I'm thinking about what's going on with tariffs. So that's been basically assigned to the Supreme Court to kind of preside over and try to figure out whether or not tariffs are going to be deemed illegal and an overstep. So clarity there would be good for equity markets. Fed independence is another thing that we're hoping to see the Federal Reserve continue to maintain its independence. We think that's a positive for financial markets.
I think you hit it right on the head. I mean, the Supreme Court, I think, hopefully will have a decision before the end of the year on the tariffs. And imagine if they were made illegal or deemed illegal, and then the administration would try again with other regulations, and we have a rerun in 2026 and 2025. And I have people say, and I actually do think that the Supreme Court upholds these tariffs. We can look, we at least they're 80% done, and you can move along in 2026, and businesses can start investing again. So I think that's a really, really great point. Well, thank you so much for joining us today. Really appreciate your insights, and I look forward to speaking with you again.
Likewise. Thank you for the conversation. I really enjoyed speaking with you today.